know we talked before with, I know we talked what, a year ago or 2 years
Yeah,
ago.
yeah,
And I couldn't grasp because I still was new at really doing options. I was like, I just cannot grasp what he's trying to tell me because it's a
okay.
lot to intake that.
It is. Yeah, there's definitely a learning curve. I mean, it took me a few years of just studying to figure out most of what I do, and I'm constantly learning too. So, it's a never-ending just growth mindset of just learning more and more, right? What brokers do you use? Use Thinkorswim or Tasty Trade?
Yes. Yeah, I really wish I could get out, but I don't really want to transfer the money and learn. I'm set up with Ninja and Interactive Brokers, but I don't have money in there,
Yeah,
and unless you say, well, if you take, I don't know what I'd have to transfer over to
yeah.
work with what you're doing. I don't know the amount I need.
Um, but you have funds in Interactive Brokers or Ninja right now?
I No, I mean, I'm
No.
set up. My accounts are active.
Yeah. Um, I'll show you trades that you can do if as little as about $450, $460 or so. Some of them are relatively less funds for stocks. And then for futures, you'd probably need about double that for one trade. So about $1,000 or so. All right. I'll show it on Thinkorswim because the platform's very similar to Interactive Brokers.
Yeah, that's what I've got up right now, Thinkorswim. They just charge so much.
Yeah, it's a bit high. That's just the cost of doing business, right?
Right.
All right, so I want to go over some of the general settings I use first. Do you see my shared screen?
Mm-hmm.
All right, so on the trade tab, if you type in anything, I'll just do SPX. First, you'll have these little parentheses. These mean the days till expiration. So today's the 24th of January. If it says zero, that means it was the same day. Tomorrow, one day, and so on, right?
Okay.
Um, in general, the further out you go, the further away you could go from the current price and then still be in a relatively safe position. So when you look at my stock-based trades, I usually go at least 20, sometimes 25 days out. And sometimes I'll go as far as like 45, 50 days out. And
Okay.
as we're gonna see in these pricing, it usually works out better to go a little bit further out in time. So
Okay.
let's just look, say 5 days out, about a week.
January 29th.
Yeah. Now
Okay.
the settings I have on my end are just bid and ask, implied volatility. You don't even really need it. The main ones that you want are delta, and then you could use theta if you want to, but not absolutely necessary. This is my paper trading account anyway, and I don't even use my computer. I just use my phone mostly. Delta is by far the most important one to look at. So we're going to look at different deltas and what happens to the price. So SPX ended at 48.68 today. If I go all the way to, let's say it's 48.70 pretty much. If I go to 48.70 and 5 days out, let's say we think that the market is bullish and is going to keep going up. What you can do in this case is sell a put. And the way to do that is on the right side of the screen here are the put side.
So wait, I'm going to write this down. So if I think the market is bullish, right,
Right.
then I would sell a put, right?
Yeah. Now, if you sell it right, it's called at the money pretty much. So 48.68 is the current price. Let's say we sold the 48.70. The number right here says 19.3. That is
Yes.
that is the premium that you would be collecting when you sell the option. Okay. So all you have to do is click on the bid. Interactive brokers do the same thing. Click on the bid. That automatically sets up a sell order. And in this case, we would want SPX to essentially be above the 48.70 price. Okay.
Okay.
And that is in the next 5 days in this case, because we did a 5-day expiration. Okay. So far, so good.
Oh, okay,
I'm trying to go pretty slow, so just to make sure you understand everything I'm saying.
okay,
Next is, at this point, you see the delta. The delta is the approximate percent chance that it will go to this price or lower at your expiration date. Okay. So as it is now, it says 0.48. There's about a 48% chance that it's going to be below the 48.70 price. Pretty much a coin flip, right?
okay,
Either it'll go above it or it'll go below it.
okay,
Now, this isn't necessarily a good trade because it's a coin flip. You might be right half the time and be wrong half the time, right?
okay,
So what I tend to look for are lower deltas, because remember the delta is a percent chance it will go below that price. If we have a lower delta, there's a lower chance it would do that, right?
okay,
So if we look at, say, 4,800, 4,800 is 68 points below the current price. At 4,800, the delta will be 0.10. That means there's about a 10% chance it will go below that. And that pretty much makes sense because SPX could stay where it is. It could go up a little bit. It could go up a lot. It could go down a little bit. As long as it doesn't go below this 4,800 price, then this trade would work in our favor and we would get this premium. The premium here is 2.75. So that's quite a bit less than the first number we talked about, 19.3, right?
okay, yeah.
Now, why do you think that this price is lower than the current at the money price?
Why is the 4,800 less?
Yeah, why is this 4,800 less than the 4,870? Think about it with
Well, because
probability,
I know it's out of the money, number
Mhm.
one, and
Right?
and it's just probably due to probability
Yeah,
of getting to where 4,800. That's pretty far away. That's
yeah,
far out.
it's pretty far away, especially since there's only 5 days left, right?
Yeah.
So this is a pretty highly probable chance that it would work in our favor, right? So now what we're going to do is look at a later expiration date, because in this case, we only have 5 days for the stock to move down at 68 points. Remember, 4,800 is about 3 or so. It's the middle of the bid and the ask price. And you probably know that when you're buying options, right? You
Mm-hmm.
sometimes get somewhere near the middle of it. So let's
Yeah.
just, easy math, let's just make it a 3.
Okay.
What if I go a month out to 30 days out, and then you look at that same 4,800 price? Do you think that this premium will be more or less than when it was at 5 days at 3 premium?
Hold on. 30 days out.
Yeah.
I
Do you think it's going to be bigger or smaller?
think it'd be larger, but
Yeah. Why do you think it's larger?
the probability is higher,
Right. There's more
right?
time for SPX to drop, right?
Uh-huh.
Because in the next 30 days, there's more uncertainty. We don't know what's going to happen in the next
Oh,
30
good
days.
gosh. Yeah, look at it. Okay. 4,800. Wow.
Yeah. Now, if you look at the 4,800, look at the delta, 0.29. Do you remember what this means? The delta?
That's the percentage it will change, right?
The percent that it could go below that 4,800. Okay.
29% it will go below.
Right. Now, if you look at that same 4,800 price, as you go further and further out in time, the delta will be higher because there's more time for it to drop. Okay.
Mm-hmm.
Another thing that you could look at, which is very similar, let's look at that 3 premium from before, and we're going to look at the 30 days out and find where the 3 premium is to collect the same amount of money, right?
So we're going to where now on the same February 20?
Yeah, the same 30 days out instead of the 5 days. Remember at
Okay.
5 days,
Uh-huh.
at 5 days, we had to go to 4,800 to take in around 3 in premium, right?
Uh-huh.
If you go 30 days out, we could go all the way to 43.30 to take in that same 3 in premium, right? So in both of those cases, we'd be collecting the same amount of money. Obviously, you're not going to make as much per day if you have to wait 30 days than 5 days. But same amount of money, look at the delta on it, 0.03. There's only a 3% chance that it would get below this 43.30 strike price. Does that make
And are
sense?
we looking for a lower delta? Is that what we want?
In general, yeah, because you want trades to work in our favor, right?
Okay.
So we want low deltas, but there's also a fine balance. You don't want a super, super low delta because then it may not be worth the amount of money you have to put up in the trade and how much money you could win, make in the trade, right? So there's a
And you
fine
don't care
balance.
about you don't care about the open interest, the amount of volume or anything. That's
Good
what is.
question. For the stocks that I look at, the volume and open interest is always pretty high. So it's
Mhm.
really not an issue. If you're looking
Okay.
at small cap stocks and meme type stocks that don't have a lot of people trading it, then it does matter more. Because if your open interest is low, the bid and the ask spread, the difference will be pretty large. Okay.
Mm-hmm.
So
Mm-hmm.
most of the trades, pretty much all the trades I do, have pretty high open interest. Because I don't want to lose a lot on this spread. Okay.
Okay.
Let's go even further out. Let's go all the way to say 114 days out. So that's almost 4 months. You could go to get the same 3 premium. You could go to 30.75. That is a huge drop, right?
Yeah.
And the delta is only 0.01. There's only about a 1% chance the market's going to drop about 1,860 points or so to make that same money. Okay.
Hmm.
So one of the key things that I do is I look to go really far out in time because then you get that really big cushion. You can go really far out of the money compared to the strike price. Okay.
Okay.
Now, again, it's a fine balance. I wouldn't necessarily want to do this trade because you can make $300, but you're gonna have to wait almost 4 months to essentially win in that trade and then get out of it, right?
Mm-hmm.
The kind of sweet spot deltas that I look for is around 0.05 or so, all the way to say 0.15 in pretty much every case. And I usually like around 0.07, 0.08. That usually gives a good balance between taking in enough money for it to be worth it and having that highly probable trade. Okay.
Okay.
Now, in order to take, let's go back to that, say 30 days out. I'm going to show
Okay.
you the credit spreads next, which should be one of the first ones
Mm-hmm.
you probably do because you only need $500 for these.
Okay.
So let's look at say 0.07 delta or so. 30 days from now, we could go to around 45.50 and we could sell that put. Now, the issue is if I just sold this put, you're going to need 45.50 times 100 because options have to do with 100 shares, right?
Mm-hmm.
So this particular trade, I would need $434,320. That is a lot of money. I'm not going to be doing that trade just to make like about $300 or so, right? So what we could do instead is make this into a credit spread. The way to do that is you're going to sell the first number that I give. So you're going to sell the 45.50. And then maybe I would go 45.40. It's only 10 away from the 45.50. And I want to buy by clicking the ask price. You're going to buy that option. Okay. So this is called a credit spread. That's when you sell one option at a little bit higher price and you buy the option a little bit below it. Okay.
Okay. Say that one more time. So a credit spread is when you say that again.
You're going to sell one put at a little bit higher price. So I sold the 45.50. And then you're gonna buy and put right below it. So a little bit further out than the original one.
which
Okay?
was the 45, 40.
40 in this case.
I'm sorry, what? 45?
Yeah, 45.40.
Okay, hold on. Okay,
This is
so
just
you,
this is just an example. I wouldn't necessarily do it.
okay, sell one put at the higher price and then buy one below it. Okay,
Yes. Now in this case, you only take in 0.35, multiply by 100 to get options. You would make $35 or so in this trade, but you don't need $454,000. You only need the difference or the width of the spread. Okay. So in this case, 45.50 minus 45.40 is 10, right? So
uh-huh,
in order for this spread, you only need 10 times the 100 because options are 100. 10 times 100 is $1,000, right?
okay,
So 10 times 100 right here, $1,000. In this case, you can make about $30 using only, it's actually a little less, it's $970. The way they figured that out is this was $1,000, the difference of the spread, but then you subtract how much money you took in on the trade. You're essentially doing 1,000 minus $30. Okay.
okay. So I'm seeing how you even did this on the bottom of your thing. You went into, oh, you did vertical.
Yeah,
So
it's a
see,
vertical.
how do I get mine to say vertical?
On IBKR, I think there's buttons for different strategies to look at. You'd want to click on the vertical one.
Oh, wait, I think I have to right click it.
Yeah, it's a little different on your end, but
Wait a minute. How do I do this? Oh, okay. Oh, I see it. Okay. So I clicked it. I see buy, and I'm going to put buy. No, I want to sell.
sell it.
Sell a vertical, right?
Right. Yes.
Like sell. I have to, I wonder if I have a way to make that not so complicated. Sell vertical
Right.
and then buy. Oh, that automatically came up.
Yeah, and then in that case, you probably have to pick the strike prices you want.
So yeah, I've got a sell 45.50 put. Then it
Mm,
says buy one 45.40 put.
yeah, that'd be right.
They're both would say puts, right? So that's
Yeah,
automatically done, and it says price 0.30.
right. So that's exactly what I show, right? Point,
Okay, yeah, okay, I see it. Yeah, I'm just used to seeing this 670, 6.7. So I'm like, oh, it's
uh,
and you got limit day best. Okay,
point day best is fine. You don't have to mess with that.
okay, all right.
Let's look at the trade. Let's look at the trade I did today. Let's see if you get entered in right on your end. Okay.
Uh-huh.
So if we go to the trade alerts under option trades in Discord, I did Netflix today. So try to put it in on your end. Type in Netflix, NFLX. And then I went to the February 26th expiration. So we're gonna go to February 20, I'm sorry,
Third.
February 16th. Sorry.
Okay, February 16th. This was
Yeah.
under your theta trade. I'm gonna see what it looks like.
Yeah, it's
Under
an option trade
option.
channel. That would be the first type of trades you should do for a bit.
What is that under? What'd you put that under?
Your option trades is on the
Oh,
trade alert.
yeah. Okay, is this PCS? Whatever
Yeah.
P.
PCS means put credit spread, just like we did.
Okay, gotcha. All right.
So we go
Okay,
to
I'm under Netflix.
216 expiration.
Okay.
Then
Buy.
I wrote, we're going to sell the first number. So we want to sell the 505. You could maybe click vertical or right click for vertical.
Okay, I gotta do sell first. Oh, okay, sell
Yes,
vertical.
all vertical. Then you
Uh-huh.
want to click on 505 for the one you're selling. And then we're
Hmm,
gonna buy the 500. That's the second number I put.
I have to change that. They put 502. So change it to 500. So I got sell 1 505 put, buy 1 500 put.
Exactly.
And it says 57.
Yeah, 57. No, the market's not open, so the numbers could be a little different now than there was before. In my alert, I said get at
Oh,
least 0.33 on it. And then I wrote I got 0.38. So the reason why I do that is I write what I got on my trade. If
uh-huh.
you're free, then you'll pretty much get the same thing I did. If you're busy and you have to do the trade in an hour or two, or even tomorrow morning, try to get at least that 0.33 that I wrote. Okay. So
So,
if it's a lot less than that, I would probably skip that day. Because sometimes, like if the market went up a lot tonight into tomorrow, it could be lower than 0.33 possibly. So just be aware of that. Okay?
okay.
And if it's a little more, like it looks like it's a little more now because Netflix dropped a little bit after I did the trade, it's fine taking it if it's a little bit more. Okay.
Okay.
So then all you do is place that order.
Did you just do one? Is that all you did?
I
One?
did I did three, but you
It's
could start with one if you want. You could do as many
uh,
as you have the funds for, to be honest.
so let me think. That's I look at that price, just say right now, it says 57.
Mhm.
Okay. How do I figure out the price, the cost, or
So remember the cost is the difference of the spread. 505 minus 500. That would be 5. And then you multiply by 100 because they're options. It's essentially $500 you would need for the trade minus whatever you took in your credit for this price number. And I
my,
always do these for pretty much always do these as a 5 with spread. So you'll always need a little under $500 to do one of them. Okay.
so and you said minus the which number?
The price number 0.57.
0.57.
So it'll be 500 minus $57, about $443 or so.
Okay.
What's neat about selling these spreads are you get that premium immediately into your broker's account. So you're gonna get that $57 in your broker's right away. You're still in the position now. So your total account might move up and down based on what happens with it. Okay.
And then how do you close this out or
Yes.
no?
So
Oh,
if you go to the other channel that says closed trades, it's a little bit below under member chat. There's a channel for closed trades.
okay.
That's where I say when I close out a specific trade. Yeah. Like today it says closed T row 0.18.
Uh-huh.
So in that one, I sold it for more than 0.18 and then I bought it back for 0.18. The reason why I did that is I got out of the trade and the profit was the difference of what I sold it for minus what I bought it back for. I sold it for 0.35. So essentially, I took in $35 when I started it per contract. And then I'm going to subtract the 18 that I bought it back for. I'm essentially like a wholesaler, so to speak, where I find a good that I'm could buy at 0.18, but I'm actually selling it for the 0.35 first. I essentially sell first to buy back later. Okay?
Mhm.
And then in this case, I would have made the difference of that because I sold it, took in 35, I bought it back for 18. So I made $17 on that trade. Remember, you use about $500 on the trade. So I made 3.4% on my $500. Okay.
Mm-hmm.
And that's a good trade. If you do that over and over again, make I usually look for 3 to 5% or so on the trade. You do that over and over again, you're just going to be well. It'll take a little bit of time. These aren't like buying options for, say, $200, selling it for $300. Like I'm looking for highly probable trades that will most likely work to get about 3 to 5%. Okay.
Mm-hmm. So how, I guess, how do you close the trade then? So,
Once the trade is open on this end, so
uh-huh,
it's probably in your positions tab or monitor tab, you'll see the positions you have.
uh-huh,
Here's a sample one I have on the paper trade.
okay.
Once you have that position, you might have to right click it and then create closing order. It's going to look something like that.
Okay.
You might need to it's the opposite of when you get in the trade. So when you're buying options from like Nate Bear or something, and then you close it out, it's pretty much the same steps you do. So I don't know how you do it on IBKR because I don't use that, but it's the
Well,
same
I'm on
for Ninja.
TD. I'm on Thinkorswim, so
Okay. Yeah, it's the same thing. So in your monitor tab, you'd want to find your position. Like let's
okay.
say the Netflix one, Netflix would show up here. You want to hold the control button and highlight the position. Like let's say that this was the put credit spread I did. You just control click on both of them. And then you right click, create closing order. So create closing order will essentially do the opposite of what we did. We started by selling it. By create closing order, we're going to buy it back. Okay.
Just do the, okay, buy it back.
And then you'll see the order position come up right here. You want the price of your debit to be smaller than what the initial credit was. Okay. So say for Netflix, we might have sold it for around 50 something dollars. If you could buy it back for about $30 or so, then you just subtract those two numbers. You would make, say, $20 on that trade. Okay.
Okay. And then
And I'm
just hit
doing,
confirm.
yeah, yep, confirm and send. And
Okay.
then just let it go. You can make it a good till canceled order if you want, and just let it sit there. I'll sometimes do that. Like once the order's already filled and you already have it open, let's say I sold it for $50 or so. I might do like 0.3, that'd be $30. And then I'll make it a good till canceled order. So then if the option gets down to the $30, then it'll just close it for you. Okay. You might do that
Okay.
when you buy options too, right? Like if you buy a call, let's say $200, you might do good till cancel to sell it at say 250 or $300, whatever it is, right?
Mm-hmm.
And then that's
I don't know.
essentially
I just scalp in and out. So,
yeah. You could close it at any time, whatever the current price is. So
and
how do we
I don't
actually?
rush to close things. That's
Yeah,
like if I'm coaching and you go, oh, I closed my trade out this morning, and I'm like, oh, I'm sitting there coaching a couple classes, and I look and I go, oh my gosh, you closed this trade.
right.
I have time to do that later in the day, correct?
Yeah,
Okay.
these are usually longer dated. This is 23 days out, and that's
Okay.
actually a bit low than I usually do. I usually look around 30, 45 days.
Uh-huh.
So on Monday next week, we're going to switch to the March expiration dates. So we're going to go out to say March 15th, starting Monday. That'll be
Mm-hmm.
about 45 or so days out. So there's not a huge rush to get out of these in most cases.
Do we do better? Are these credit spreads done? There's so many I've learned about that. They do very much better in sideways markets
Yes. So how
versus,
do we make money on it? We went over this in the beginning. You remember when SPX at 5 days out was a big price, 30 days out, it was a lot bigger, right?
Mhm.
If you're going the opposite direction, if we sold the option, we want we want Netflix in this case to stay where it is, go up, Because if it goes up, then you're even further away from it and further out of the money. Or you just want the time to decay it out. So remember, at 30 days out, it's like $50. If Netflix stays exactly where it is, and say 2, 3 weeks from now, then there's less time for it to drop, right? And in that case, those premiums will be less. And that's what we want. We want to sell high and then buy lower later. It's like the opposite of what you're used to. We sell first, we buy it back after. Okay.
Mm-hmm.
Yeah. So yeah, we make money again if Netflix stays where it is. There'll be less time to drop. Or if Netflix goes up, we're further away from it. Even if Netflix drops a little bit, sometimes it's worth less anyway because there's less time too, right? So that's why I'm looking for those highly probable trades. It was a 0.1 delta when I did the trade. So that means there's a 10% chance it goes lower than our 505 strike price. That means that there's a 90% chance it doesn't, right?
Mm-hmm.
So in this case, the odds are on our favor. We have a pretty much, if you do this 10 times, 9 times out of 10, it's going to work, right? That's just based on the delta and the probability. Okay.
Okay.
Okay, I have a few more minutes. Any other general questions on that?
No, I mean, you'll have to bear with me when it comes to like when I do this trade, I'll be probably going, wait,
Okay.
did
Yeah.
I do this right? And
No,
usually, how long do you hold on to these types of trades? Is
the
it different for
average
each one?
the average last year was 12 days.
Oh,
Some,
okay.
some of them are quicker, some of them will take longer. So on the closed trades tab, I show when I close all of them out. On the closed trade tab for, you know, T Rowe Price, it was 13 days. Amazon was only 8 days. And then I did one for coin a few days ago. That I got in and out in 3 days. So it really depends on what happens with the stock. I look for around 3 to 5% in most cases.
Do you
That's
mark support? Do you do like before you take them? Like, are you going in and going, okay, here's support, here's resistance, or here's supply demand, and you
I
base it
do
off
a
that?
little, yeah, I do a little of that. If you look in the option trade, I give in the parentheses, I give a little reason why I took the trade. So
Okay.
Netflix, I took it because it had strong earnings. The stock went up over 10%. So I think momentum will keep it at least where it is, or maybe keep going up. I do that usually. I usually look for more momentum type trades where I think the stock will continue going up. And remember, I'm selling way lower than that. So I don't mind it going up. I'm further away than right?
Okay.
Another, sometimes not as much. I'll look for the support levels. Like say the stock is over here and the support level is a little lower. Maybe it happened like a month ago. I'm going to try to sell even lower than that. So then if it happens to bounce and touch the support, there's a good chance it might recover from there. But I
Oh,
still
okay.
give myself some cushion. I'm going to sell even lower than that price.
Okay.
Yeah, these are all like you could do that stuff, but it won't really matter much in the end. It's based on the delta. You can think about it just based on probabilities. If it's a 0.1 delta, there's a 10% chance it will go lower than that. That means there's a 90% chance it doesn't. It's almost like you're a casino owner and you're taking bets from people making silly bets, right? So they're betting on like number 4 in roulette popping up. Most of the time, it's not going to happen. So you just collect their premium, you collect the chips.
Do you ever just buy options? Like you go in and you go, oh, I'm just gonna buy just a,
Almost,
I guess you call it the naked position, maybe. I don't know.
yeah.
We just go,
I almost never do that. The
you don't
odds
do
are the odds are against you. Remember when we looked at the SPX at 5 days out? If you bought it, you have to pay that premium. If you say bought a call option thinking SPX will go up, it has to go up not only where you're currently at, it has to go up the premium you paid by expiration date. A lot of the trades you look at, you're maybe getting in and out quicker. So
uh-huh.
you don't necessarily have to go up that much, but you need the stock to move in your direction and you need it to move in a short period of time. So
With
those,
volatility.
And
definitely.
volatility too.
That's so much because I literally will just right now I'm just trading SPX. I don't do anything else. I just look at it.
Yeah.
I watch the
Right.
futures, and then I just go in and usually I try to buy as close to the money as I can.
Yeah.
And my hardest part is trying to find when volume is coming in. That's where I'm kind of lacking is like I'm trying to see. I don't know how to see if volume's picking up. I just have to judge it by the candle, and I keep UVXY up. And today I thought it was odd because I go, I don't understand. UVXY is going up. I'm watching
Yeah.
SPX climb up. They're
Yeah.
supposed to go opposite from each other. So I was getting nervous about jumping in
Yeah.
the trade.
It
You know, and
happens sometimes. It doesn't always happen, but it could happen that way. That's
yeah,
why
that
it's
was odd because it
yeah,
hasn't been doing that today. I was like, something's not right. Like
right.
I think something's about to break, but I'm not sure which way. So I was like,
It's a hard game to play because you got to be right on direction and time, and it's hard to be right on those consistently. So that's why I almost never do it. I pretty much only sell options.
well,
All right,
maybe if I can get good at that, that's all I'll ever have to do. But right now, I just try to
that's
quickly
all
get
I
it
do. That's all I do.
100.
And I'm reaching my goals. So,
Okay.
all
Well,
right,
thanks for your
no
time and
problem.
help.
I'll send you the recording on this and ask any questions on Discord as you have them. Okay.
Okay. Thanks.
All right. Have a good rest of the evening.
You too. Bye.